Hi there, class. The purpose of the video here is to review with you the Class 6 in-class exercise that we went through at the end. This is the, quote, extra problem that we created to facilitate review of everything in classes 1 through 5. And this is also the problem that we walk through the solution for using the Excel template. And a number of you asked for a video to review that in-class exercise going through the solution by hand, as I've done in other videos and I do in class. And so the purpose of this video is to do that. I have to say, I'm not sure why I'm doing it for you, but maybe there'll be good karma in it for me. In any event, so let's go through the problem. So on your screen is the problem. And I'm going to flip off of that in just a second, but I want to make sure we're on the same page that this is the problem we're talking about. So this ABC company, $5 million of book income, and Anna will have sent you the Excel file with the solution using the template as well. Okay. Okay. So with these guys, they have both federal and state. So I'm going to do the state provision first, because I'm going to do my jurisdictions one by one. So this page is going to be state. And what I'm going to try to do is I'm going to try to use the same format I've used before when we went through some homework problems. And let's see, I'm going to make this section over here my current. And so let's go through the current calculation. Okay. So I have PBT of 5 million. Penalties of 50,000. Bad debts, call that bad debt reserve, of 45,000. Book depreciation in excess of tax. So if books is higher than tax, that means we got to add back 300,000. Meals and entertainment of 80, which means I'm going to add back 40. And our stock compensation. Okay, so we have two items of stock compensation. The first one is an ISO, and it's current year expense related to an ISO grant. And we know that with an ISO grant, we have to assume that that's permanently non-deductible until there's a subsequent exercise and deduction. Okay. Then we have an NSO. And with our non-qualified stock option, there's a tax deduction of 35, right? And the assumption in the problem will say that the previous stock comp expense for book purposes was 60, but the deduction for current taxable income purposes is only 35. So if I sum that up, it should be 547,000, so 5,470,000. And my blended state tax rate is 8.5%, 8.55%. I just get that by combining the apportionment and tax rates. So if I calculate this tax liability before credits, it's 467,685. And I have one state credit, which is a Michigan credit in the example, 42,000. So my net state tax liability is 425,685. Okay, so that is my current provision. All right. Now let's see. If I do, I'm going to do my state provision. I need to get out a calculator here. I'm going to do it a little bit differently than the solution, so I'm going to pause every once in a while and do some math. Okay, so now I'm going to do my deferred provision. Okay, and the way I'm going to map this out is I'm going to have my beginning of the year deferreds, my change on account of my current payable, and then I'm going to have any shortfalls related to my stock awards, and I'll have my end of the year deferred balance. Okay, so of my deferreds, I have a bad debt, depreciation, and an NSO. So at the beginning of the year, I had neither bad debt or depreciation, at least not according to the assumptions in the problem. But I did have an NSO temp item of $60,000. Right? Okay. So, with respect to my bad debt reserve, I increased it, as you can see from the left of this screen. I increased my temp item by $45,000, so that's going to create a future deductible difference, $45,000. Depreciation is the same. And with respect to stock compensation, I took $35,000 of the $60,000 at the beginning of the year, and I reversed it through my current calc. Okay. So that temp item is going to be $310,000 of net change. Right? I know that my stock compensation temp item has to go to 0 at the end of the year because the NSO is gone. So I put that $25,000 reversal in as a shortfall because that's what it is. Right? I have DTA left after the $35,000 deduction, and I need to write that DTA off. Okay. So if I take these numbers all times, okay, so I'm just going to say at 8.55%, that's going to equal, so I'll take 60,000 times 0.08855, and that is 5130. And if I take 310,000 times 0.0855, that is 26505. 25,000 times 0.0855 is, I did the math wrong, 25,000 times 0.0855 is 2137. And at the end of the year, my temp items, my 345 times 0.0855 should be 29,497. 29,497. Okay. All right. So if I was going to come up with journal entries for these guys, then let's see if we can't do that. Just at the bottom here. So my journal entry for my current expense would be debit provision for 425,685 and credit payable 425,685. And over here, this entry, I would say that it is debit DTA for 26,505, credit provision for 26,505. That's my deferred provision benefit. And then for this guy, I would say debit provision. Oh, sorry. I'm going to say that I have EPIC pool. Almost went down the wrong path on that one. Okay, so I'm going to say that that write-off of that DTA is going to go through APIC 2137. 2137, and credit DTA for 2137. Okay, so that's going to be my state provision. Okay. I'm actually going to see if I can print that slide. I might need it when I do my federal, and it'll be a little difficult to see that. Okay, so you can stare at that provision for states. Make sure you understand that. I'm going to go grab the printout, and then we'll go through the federal provision. Okay, I'm just going to check my math. If I add up those two components of the provision, so I have a benefit of $26,505, and I have an expense of $425,685. So that is $399,180, and that is miraculously the same answer that Anna got to on the Excel file before. Okay, but this is in a different format. Okay, so then let's go on to the federal provision. This one I'm probably going to have to space out a little bit more because, yeah, I guess I'll try to fit it in the same type of format. But it could be a little tricky. Okay, so federal. Okay. So if I do my current calculation, I'm going to cheat a little bit now that I have my printout so I don't have to rewrite everything. If I start with my state taxable income, that was 5470. Right, that was the amount of income I had after computing my perms and temps for penalties, bad debt reserves, all that other stuff. And so the only difference between federal taxable income and state taxable income is that we are going to deduct in the current year, for federal purposes, the amount of state tax liability that we have. Okay, so we're going to put in our state, what I'll call our state deduction. Okay. And our state deduction is going to be $425,685. Okay. So after I factor in that deduction, our taxable income for federal purposes is $5,044,315. And our tax rate is 35%, and that tax is 1766510. And I have credits of 47,500. So my state tax liability net is $1,718,010. Okay, so that is my current federal calc. Alright, so let's go over and do our deferred calc. So if I have beginning of the year, and then I'll say current year change, shortfall, and end of the year. Again, I have I've got a handful of deferreds. I've got my bad debts, my depreciation, my NSO, my non-qualified stock compensation, and then the kind of the brain, the challenging one, the Fed benefit of state, the federal effective state. So at the beginning of the year, I had no bad debts, no depreciation, 60,000 of temp items for NSOs. And if you remember back from our state provision, our beginning of the year deferred for state was a DTA of 5130. So that means I have a taxable temporary difference of 5130 for federal purposes, because if I'm going to save state tax, I'm not going to be able to deduct federal tax. Okay, so if I sum those up, that's 54,870. Right, and then 35%, 54,870 is 19,205. Okay, so for activity during the course of the year, let's see, I've got 45,000 for bad debts, 300,000 for depreciation, 35,000 for my NSO movement. And then on the state side, again, you'd have to flip back to the prior page, but on the state side, my movement here in states is 26,505, and that means there's going to be an inverse effect on my federal calculation. Okay, so this 26,505 is going to move this way, right? Because I'm going to save more state tax as I have a build of my state DTA, which means I'm going to have even less of a federal deduction in the future than I thought at the beginning of the year. Okay? And as far as my shortfall goes, just like for states, I would have a shortfall of 25,000. So at the end of the year, I'd have a temp item for bad debt of 45, temp item for depreciation of 300. My NSO is gone. And with respect to my Fed benefit of state, okay, this one gets confusing because in my shortfall, I actually have a federal APIC effect of this shortfall. Okay? So when you look at this 2737 right there, what that stands for is I had a state temp item that I have written off to equity. I've said, look, that deferred tax asset's not going to be realized. I'm removing it. I'm writing it off to equity. But that deferred, that was really just a component originally of that balance, right? And so with respect to that balance, that carries over to my Fed effect, right? At the beginning of the year, I said all my state deferreds have a federal effect. And now, as I write off some of those state deferreds, because of APIC, because of a shortfall, there's a Fed effect of that too, right? There's a Fed effect of my beginning balance, and all I'm doing is eliminating part of that beginning balance through APIC. And if the beginning was Fed affected, the adjustment's got to be Fed affected, right? Otherwise, you're just not going to get to the right answer at the end of the day. So that 2137 is just the flip of what you see on the state schedule, but it's really you saying that I thought by showing this 5,000 taxable temp item at the beginning of the year, I thought I was going to have less of a federal deduction in the future because of these temp items. Well, that didn't turn out to be the case because I had a shortfall. So I'm not going to suffer as much of a reduced future deduction. And that's why you see this positive number in the shortfall column here. And I'm running it through APIC because the entire effect, Fed, state, and Fed effective state, all that is running through APIC because of the accounting rules related to shortfalls. Okay. So let's do some math here. So if I take the state or the Fed effective state and foot that across, that should get me to 29,498, which is exactly what we had in the state ending deferred. It's up by $1 rounding, but otherwise it's exactly the same. Okay, and so then if I add up those numbers, that's 315,503, 315,503, and 35% of that is 110,426. 110,426. Okay, and now let's just start filling in the math here. So 25,000 minus 2137, 22. Okay, this is 22,863. 35% of that is going to be 8,002. Okay, so my write-off of my federal deferred to APIC is going to be $8,000 or $8,002. Okay, so let's add up this column. So 345 minus 35 minus 26,505 should be 283,495. Oh, oops, I was holding the button down. Okay, 283,495, and that times 0.35 is 99,223. Okay, so let's make sure that this foots across. 19,205 plus 99,223 minus 8,002 is 110,426. Okay, so that foots across. Now, let's see if we can come up with journal entries. Okay, so our journal entry for the current is going to be debit provision, 1.7 million, credit payable, 1.7 million. Sorry, it's getting messier as we go. My journal entry for my current year activity is going to be debit DTA for the 99,223, credit provision for 99,223, and this entry will be debit APIC 8,002, credit DTA for 8,002. Okay, so if I add up my provision of 1718010, that's my current provision, and my deferred provision was a benefit of 99,223. That should give me a total provision of 1618787. Okay, so let me just print this page too, and we can then do the rate rec together. Okay, again, so hang tight while I go grab the print off the printer, and then we can do the rate rec. Okay, hold on. Okay. All right, page 3. All right, so if I was going to do the rate rec, I would start with my PBT of 5 million, And I'm assuming a 35% rate, so that is 1750. And the provision that I ultimately got to was the sum of my federal and state provisions, which you can go back and do the math yourself for if you want. But I'll just tell you that it is $2,017,967. And we know that there's a meals and entertainment item in here for $40,000. So that's $14,000 at 35%. And there's a penalty of $50,000? Yeah, $50,000. So that at 35% is $17,500. And we know that we had a credit, a federal credit of $47,500. And the last piece of our calculation ought to be, the last piece of our calculation ought to be our state taxes. So let me just get out the page for our state taxes. Okay, so our state tax provision, was $399,180, right? And then we should have a Fed benefit of state of 35% of that. And 35% of 399,180, 399,180 times 0.35 is 139,713. 139,713. Okay. So let's see, 399,180 minus 139,713. Okay, so that should be my rate rec, and let me just pause there so I can just do some math for a second. Okay, hold on a second. Oh, I knew I was forgetting. I just needed to do some math because my rate rec wasn't working, and I just forgot a number. And that number was my ISO. So I had 70,000 of ISO expense, which is a 24,000. What's 70,000? 70,000 times 0.35 is 24,500. Okay. Now that now my rate rec should work. Okay. So that's the problem. I suspect you were worried less about the rate rec and more about the format for these first two pages. But nevertheless, now you have state, federal, and a rate rec. Okay. Good luck on figuring out that on your own. Okay, bye.